SEBI weighs scrapping close-to-money norms and options on goods to ease compliance. Sources: as per sources, exchanges have represented to the regulator that the CTM classification adds complexity, particularly in physically settled options on goods. Capital Market Regulator. Securities and Exchange Board (SEBI) of India may consider discontinuing the close-to-money CTM framework in options on goods as part of efforts to simplify regulations and improve ease of doing business in the commodity derivatives segment, as per sources. One source said the proposal was presented to a panel related to commodity derivatives, where members deliberated on aligning options on goods with a simpler exercise structure currently followed in options on futures, under the existing framework outlined in SEBI's Master Circular on Commodity Derivatives. The strike price closest to the underlying is designated as at-the-money ATM. 3 strikes immediately above and 3 immediately below the ATM strike are classified as close-to-money CTM contracts. Falling within this CTM band require explicit exercise instructions from long position holders, as against this in-the-money ITM contracts, other than CTM, are exercised automatically unless contrary instructions are given, while out-of-the-money OTM contracts expire worthless. As per documents seen by Money Control, exchanges have represented to the regulator that the CTM classification adds complexity, particularly in physically settled options on goods. According to submissions made by exchanges to SEBI, the additional layer makes the exercise mechanism harder to understand for participants and increases operational challenges for exchanges and clearing corporations. Exchanges submitted that there is no concept of CTM on leading international commodity exchanges. Also, the concept of CTM is not well understood by market participants and has the potential to create confusion because the concept of CTM makes the exercise mechanism complex for the trade participants, and they might find it difficult to actually look into the intrinsic costs associated with the CTM options. Since OTM and ITM are relatively easy to understand, most of the exchanges offer these 2 options to market participants. Margin concerns near expiring. One of the key issues flagged relates to margin requirements near expiring. For instance, consider a scenario where the spot price of a commodity is 5,010 rupees 2 days before expiry, and call option strikes are available from 4,500 rupees to 5,500 rupees at Rs100 intervals. In options on futures, pre-expiry margin typically applies only to ATM and ITM strikes. In this example, 5,000 rupees would be the ATM strike, and 4,900 rupees and below would be ITM. Margin would therefore apply only to 5,000 rupees and lower strikes. However, in options on goods, margin applicability is broader. It covers ATM and ITM strikes and may extend to additional OTM strikes within a specified range, including those falling within the daily price limit band. As a result, strikes such as 5,100 rupees, Rs 5,200 and 5,300 rupees could also attract margin requirements. In simple terms, traders taking moderately out-of-money positions in goods options may need to block more capital compared to similar positions in futures options. Exchanges have also pointed to potential uncertainty for option writers in certain CTM scenarios, particularly around delivery obligations if exercise decisions differ from expectations. SEBI had earlier removed the CTM framework in options on futures. Aligning options on goods with futures norms may bring uniformity across products, simplify compliance, and potentially improve participation and liquidity in commodity derivatives. The regulator is expected to take a final view after considering the committee's recommendations.